Hello and welcome to our group presentation assignment 2. Our topic is payback period in capital investment appraisal. My group members are me, Halima, Noor Najiba, Al Huraybi Youssef, Ibrahim Abdul Rashid, and Austin. Here's our table of contents. Okay, first of all, we need to know what is payback period. The payback period refers to the duration measured in years required to recoup the initial or primary investment made in a certain project. The determination of the investment project's value relies on the analysis of its incremental cash flows. Hence, the assessment of different investment positions is conducted by considering the duration required for a corporate organization to recoup the initial investment cost. In general, investment initiatives that have a shorter payback period are typically favored over alternative investment projects. Okay, so the characteristics of a payback period method. First of all, capital budgeting traditionally uses the payback period method. It helps a business evaluate an investment proposal based on its useful life and predicted returns. Second, other capital budgeting method approaches employ the value of money to evaluate the investment project but this method does not. Thirdly, small businesses use payback period to evaluate investment proposals. And lastly, business accounts are used to calculate the payback period duration. Okay, now I will pass to my friend Najiba to discuss the advantage and disadvantage of payback period.
My name is Noor Najiba binti Salamat Ali. My ID number is 2021010200001. Today I want to talk about advantages of payback period. They have four. The first is the payback time as a choice criterion is the ease of computation, and the second is the payback time is that is represents the project liquidity and risk, and the third is a shorter payback period suggested that the initiative frees up funds for other purposes, and then lastly is the a shorter payback time indicates that a project recover its original cost more quickly, reducing the firm's susceptibility to unpredictability. And then disadvantages of payback period. Firstly, is the payback time has numerous serious drawbacks that restrict its reliability and usefulness as a choice criteria. And then second is the payback period also has the problem of ignoring financial flows that occur after the payback period. And the third is the payback period does not take into account the project profitability or return on investment after the break-even point. And then lastly, the payback period assumes that all cash flows come at the end of each year without discounting them to their present value. Thank you. That's all.
I'm Yusuf Al Huraybi. As my part, what is the unacceptable payback period? The shortest payback period is widely seen as the most acceptable. This is an especially important rule to follow when a company must choose between one or more investments. The reason for this is that the longer money is locked up, the less opportunity there is to invest it elsewhere. Calculation of payback period. The payback period is nothing but the number of years it takes to recover the initial cash outlay invested in the particular project. So, the payback period equal initial investment divided by annual payback. Thank you. Now I will pass to my friend.
Yeah, thank you, Yusuf. Yeah, here is a quick, I will be discussing on the example. Amir Enterprise is considering investing in a new product line. The cost of the investment is 100,000 initial investment, and expected cash flow are year one 30,000, year two 40,000, year three 40,000, year four 20,000. Yeah, Amir Enterprise are trying to determine how long it's going to take the company to recover their initial investment. In this case, this is the solution. In order for we to calculate the payback period, we need to first determine the initial investment and the expected cash flow. Our initial investment in this equation is 100,000. Then the cumulative cash flow for year one is 30,000. The year two, 40,000. Year three, 40,000. When we add up 30,000 plus 40,000 plus 40,000, we got 110,000. That means at year three, Amir Enterprise have gotten back their investment of 100,000 with an additional excess amount of 10,000, which means their cumulative cash flow is greater than the initial investment of 110,000. 100 or greater than the initial investment of 100,000, which means their payback period is going to be 3 years. Thank you.
A very good afternoon, distinguished ladies and gentlemen. My name is Agwaze Oxten. I'm a bachelor degree student of Business Administration, City University. So right now, I want to compare the payback period with other appraisal techniques. The payback period is a simple and widely used method for evaluating the financial feasibility of a project. So when compared with other appraisal techniques, it has some limitations. So right now, let's compare the payback period with the net present value. The net present value is a more comprehensive method for evaluating the financial performance of a project, unlike the payback period. It takes into account the time value of money and consider all future cash flows. NPV compares the present value of cash inflows to the present values of cash outflows. If the NPV is positive, the project is considered financially viable. Now let's compare the payback period with the internal rate of return. The internal rate of return is another widely used method for evaluating the financial feasibility of a project. It takes into the account time of money and consider all future cash flows. Internal rate of return is the discount rate at which the present value of cash inflows equals the present values of cash outflows. If the internal rate of return is greater than the required rate of return, the project is considered financially viable. Now let's compare the payback period with the profitability index. The profitability index is a ratio of the present value of the cash inflows to the present values of cash outflows. It is a more comprehensive method than the payback period. It takes into account the time value of money and consider all future cash flows. If the profitability index is greater than 1, the project is considered financially viable. Moving to the next slide. Picking the right tools on the appraisal techniques. How do you pick the right tools on the appraisal techniques? Okay, Okay, number one of it. Choose payback period for a quick initial look and if speed of recovery investment is crucial. And secondly, choose net present value, internal rate of return, or profitability index when you want to know the real profits after accounting for the time and risk. And thirdly, combine all the appraisal techniques together for a picture. Start with payback period, then dive deeper with others. But remember, each tool has its strengths. Consider your project's details and your goals. This is the end of my presentation today. Thank you guys very much. We are welcome for questions and answers. Thank you.
Okay, thank you everyone for your beautiful analysis. So lastly, in conclusion, the payback period is a quick and useful instrument for evaluating investment recovery timelines and managing liquidity and risk in short term. It should be regarded as a part of broader evaluation strategy despite the fact that it's simple, like its very simplicity, and provide valuable insights. By combining payback period with more comprehensive techniques such as NPV and IRR, businesses and companies can achieve a balanced perspective that considers both short-term and long-term profitability, allowing them to make wiser investment decisions in line with their objectives and risk tolerance. Okay, thank you. That's all from us. Thanks for listening.